Hi, welcome back. By now you're probably sick and tired of hearing me talk about Uber. But last week when I valued Uber, I got a lot of pushback from people who disagreed with my assumptions about my revenue growth, my cash flows, my cost of capital. And that's part and parcel of doing valuation. I welcome those disagreements. In fact, I find them I find that's what makes valuation interesting is people disagreeing. That said, though, there was a healthy debate I saw open up on one of the social media sites about whether the problem with my Uber valuation was that I was using a discounted cash flow valuation. In fact, the critique was that DCF, as it's commonly known, is really an old economy device. A structure created to value manufacturing companies, and perhaps it's not right to value the new economy companies that are built around users and subscribers using a DCF model. I beg to disagree, and here's why. DCF is actually a lot more flexible than we give it credit for. And I tell people if you don't like my valuation of a company, the problem you have is not with the DCF technology, but with how I've used it to value a company. So let's step back and think about the first principles of discounted cash flow valuation and whether in fact you could value a company from the ground up, from the users up. Here's the first principle. The value of any business, any asset, is the present value of the expected cash flows. It should be a function of how much you generate in cash flows and how risky those cash flows are. That first principle is true whether you approach valuation by looking at an entire company or whether you value an individual user. In practice, though, it is true that when we value companies, we tend to do consolidated or aggregated valuations. What am I talking about? If you think about my last valuation of Uber, I projected total revenues for the company, total earnings, total cash flows, and I discounted back at a composite cost of capital for the whole company. Along the way, I had to make assumptions about the total market, market shares, margins. That is a pretty standard way in which we do discounted cash flow valuation. So in aggregated valuation, we focus on the entire company. But could you actually value a company in pieces? Absolutely. And in fact, it's done frequently. Here are some examples of disaggregated valuations. If you give me a company in many different businesses, I can value the company by valuing each of its businesses separately and then adding up those business valuations. This is called sum of the parts valuation, and to do it right, you need full information on each of the businesses. I've done this before on United Technologies, a conglomerate, breaking it down to 6 businesses and valuing each business and coming up with a total value for the company. In fact, activist investors, when they target complex companies, often use a variant of this to decide whether they should break up a company. You could value a multinational by taking each geographic region, Latin America, North America, Asia, Africa, Europe, and value each region separately with different assumptions about growth and risk and perhaps even different currencies in each region, and then add up the valuations to come up with the value for the multinational. And if you look at a company built around users or subscribers, you could in fact value that company by valuing a user and then building up from that user value to the value of a company. In fact, to take a more simple example, if you gave me a pharmaceutical company, I could conceivably take the company, break it down into all of the drugs it has, which are either in commercial production or in the pipeline, value each drug and add them all up to come up with the value for the total company. So that in fact sets up the question of why we do aggregated valuation so frequently, when in fact we can break a company down into its individual parts and value each part. Well, here are some of the reasons why aggregated valuation, valuing entire companies, is more the rule than the exception. The first is the law of large numbers. What does that mean? In some cases, in fact, in many cases, it's actually easier to get an estimate of aggregate revenues than it is to get revenues of each individual item. Let me explain. Remember the example I gave you of the pharmaceutical company? Let's say it has 30 drugs. I can try to estimate the revenues for each of the 30 drugs, or I can try to estimate the revenues for the consolidated revenues for all 30 drugs. If you're going to be wrong on individual drug revenues, overestimate some, underestimate others, you in fact, the consolidated revenues you have will actually be closer to the true number than any of the individual drug revenue numbers. It's easier to often forecast numbers on a consolidated basis than it is on a disaggregated basis. Here's the second reason. To value a company in pieces, whether it's by business, by geography, or by user, you need information at that level that is often not available. Let me again Take the example of United Technologies, 6 different businesses. To value each business, I need revenues in each business, earnings in each business, capital expenditures, everything you need to actually value the business on a standalone basis. Most companies do not provide that information to outside investors. Now, it might be different if you're on the inside. You're a manager or a venture capitalist in a company, you might have access to this data to value this company on a disaggregated basis, but from the outside, it's tough to do. The third danger when you value companies on a disaggregated basis, valued in pieces, is you can miss a big piece and not even realize it. What am I talking about? Let's suppose you do a sum of the parts valuation. You take United Technologies, you take each business and you value each business. You come up with the values of the 6 businesses, you add them all up. You said, that's the value of United Technologies? Not so fast, and here's why. United Technologies as a company has consolidated corporate expenses that have nowhere to go. Those expenses are not wasted expenses. They're just consolidated expenses that right now don't show up in any of the businesses. To value United Technologies as a company, I've got to take the cost, the value drag of those corporate expenses and take it out of my value. And finally, there are lots of things that happen at the corporate level. Taxes, for instance, are not paid in individual drugs or individual businesses or individual geographies. They're paid by the whole company. You could actually argue that there are, when you talk about corporate governance, that you're not talking about a piece of the company, that it affects everything that a company does. So there are good reasons why we see aggregated valuations. That said, though, it is true that by doing aggregated valuations, you are missing some key pieces. And here are some pieces that get missing in aggregated valuations. To the extent that there are big differences in risk and growth and cash flows across businesses, across geographies, across users, you might be missing those by doing the valuation on an aggregated level. The second is, to the extent that I'm a great believer that valuations, you connect stories to numbers. But let's say you're listening to a young tech company founder describe his or her company, and he or she is describing it in terms of users. If you're not able to connect your valuation to the language being used in telling the story, you're going to get disconnected valuations. It's going to be very difficult to know what questions to ask that founder or entrepreneur about the company. And third is, if you can connect value to the units that managers care about, if it's users, subscribers, you're giving them a tool that they can use to increase the value of a company. So for instance, if I can tell you what drives the value per user or what the value of a new user is, that might play a big role in how you approach going after both new users and how you treat your existing users. So you could value a company based on users. So let's see the process by which you could value a company that is a user-based or a subscriber-based company from the user base up. To value this company, you got to value 3 pieces. The first is, to the extent that this company has existing users, you got to tell me what the value of those existing users are. The second layer is, to the extent that this company is going out and acquiring new users, you got to tell me how much value added there will be from acquiring those new users. Now you might say, what's the context of value added? Because when you look at new users, when you get a new user, you get the value of that user, but the cost you have to spend to get that new user has to be netted out against that value. And third, to the extent that you have expenses that have nowhere to go, corporate expenses, you got to estimate the value drag from those corporate expenses. So let's at least set the table on valuing each of these pieces. To value the existing users, here are some of the inputs I need. First, I need to know how much cash flow or profits you're making per user. To get this number, you need to tell me how much revenue you generate per user and what your cost of servicing a user is, to the extent that there is a cost you meet in servicing that user. That's going to give you your operating income per user. You net taxes out, you come up with an after-tax operating income. To the extent that some of your expenses are non-cash, you could even convert this into a cash flow. So your first stop is, how profitable is a user? The second question I'm going to ask you is, how sticky are users? What I'm asking you is, once you get a user, how long will this user stay with you? And what is the likelihood that you will lose them along the way? The first I measure with the lifetime for a user. So if you're in a business where once you get a user, that user is with you for the next 15, 20 years, that user is worth a lot more than a user who's going to be around for only 3 years. But there is a renewal rate you have to worry about. To the extent that users drop out, that's going to make your user base less valuable. So I need to know what the lifetime of the user and the renewal rate that you're going to get so the users continue over time. Now, there are two other things that I also have to worry about. The first is to the extent that you can take your existing users and sell them more stuff or get them to use more of your service, perhaps you can grow your profits over time. So I need to know how much growth you expect to get from your existing users. And none of these numbers are guaranteed. To the extent that you're uncertain about those cash flows you're going to get from users and how quickly you can grow them, you got to factor that in. So you care about user profitability, you care about user stickiness and loyalty, you care about user growth potential and the growth in the cash flows and the user risk in the discount rate use. So here's what I'm going to do. For an existing user, I'm going to start with the existing profit / cash flows. I'm going to grow them over time for as long as for the lifetime of the user. I'm going to adjust for the fact that some users drop out, and then I'm going to take a present value and I'm going to come up with a value per existing user. I multiply that by the number of existing users you have. That's going to give me my first building block for values, the value of the existing users. Now, if you take a look at that setup, you can already see the drivers of that value. The first is the value of an existing user will increase with user stickiness. The longer the lifetime and the less dropout you get on the user base, the more valuable a user. The second, the value of a user is directly proportional to the profitability of a user. If you have lots of users and you can't make much money of any of them, then the value of a user drops off. It's directly proportional to the profits you get from serving that user. The third is the value of a user is also directly proportional to how much additional stuff you can sell that user. To the extent that you can get existing users to use your service more or sell them other services, that's going to increase the value of a user. And finally, the value of a user will get lower if you're more uncertain about the cash flows. And that's going to be driven by two factors. The first is your revenue model is going to use. A subscription-based model is stickier because people tend, once they become subscribers, tend to be more likely to stay on than a model that requires a transaction. And a transaction-based model might be stickier than an advertising-based model. So your revenue model matters. And second, what you're selling, your product or service matters. To the extent that your product or service is discretionary, your user can live without it in bad times, it's going to be riskier than if it's non-discretionary. Now let's move to the second segment. To value a new user, I'm going to start with the value of an existing user that I've come up with. That tells me the value of a user once I have the user. But I'm going to net out the cost of acquiring a new user. And that's going to be a function of what kind of market I'm in, what the competition is, how much the market is growing. All those factors will kick in. The value per user minus the cost of acquiring a new user becomes the value added by a new user. Now, to the extent that I have more new users coming in, multiplying the value per new user by the number of new users each year is going to give me my value added from new users each year. Of course, that could build up over time, and I've got to discount them back. And the more uncertain I feel about whether I can add these new users, that's going to be factored into the discount rate I apply. And what I get as a present value will be the value of the new users. So let's look at that setup and let's see the implications there. The value added by a new user increases with the value of a user. Okay? In other words, if my users are not worth very much, the value of adding a new user is not that much. So to the extent that it costs me $100 to get a new user and I get only $105 per user, that net value of $5 means a new user is not worth very much. So I'm going to look at that net difference between the value of a user and the cost of adding a user as a measure of how much my new users will be worth. The second is the value added by the new users will also be a function of user growth. To the extent that I can grow my user base faster, for any given value per new user, I'm going to get a bigger value. But there might be a trade-off here. To grow my user base more, I might have to give up some value per user. And you might have to decide as a company whether it's better to go for fewer new users with more value per new user or more new users with less value. It's a trade-off that every growth company will face at some point in time if it's a user-based company. Here's the third component. To the extent that you have expenses that are unrelated to users, the expenses of building up a business. And I'm not just talking about G&A expenses. I'm talking about the expenses of building a business. It could be corporate expenses. It could be the expenses of your management. those expenses are going to continue over time. Perhaps not growing at the same rate, hopefully not the same rate as the users are growing, your revenues are growing. But you've got to take the present value of those expenses, allowing for the fact that those expenses are tax deductible. And what you get as a present value is the value drag created by corporate expenses. That's it. You add those three numbers together, you get a value for the operating assets of the company. So you want to try this on Uber? Now you can see already that there are inputs I will need to value users that I will not be able to get as an outsider. So some of the numbers that I'm going to use are frankly based on very little. They're thin gruel. But to the extent that you're an investor in Uber or you have access to more detailed numbers, replace my numbers with yours. So here's where I started. I started with the very little that we know about Uber. Uber's financials are not public. It's a private company. But in 2016, they gave us pieces of the puzzle. Uber said that in 2016, their gross billings amounted to 20 billion. The net revenues were about 6.5 billion, and their operating loss was minus 2.8 billion. I'm going to take those numbers as a given, even though I know those operating losses are understated because they don't include stock-based employee expenses. No, we won't go there. That's another fight. The 2015 numbers indicate that Uber had a pretty big 2016. They doubled their gross billings. They more than doubled their net revenues. They almost doubled their losses, which is not good, but they doubled almost everything. We do have some user statistics in Uber. Roughly speaking, at the end of 2016, Uber has about 40 million users, some more active than others, but we'll take the number as a given. That was a jump of about 16 million from their 2015 users. None of this is official. These are based on other people's estimates, so some of these numbers are more precise than others. So the numbers you see in yellow are the numbers that are actually out there that I'm going to start with. So here's what I'm going to do. I took the number of users and I used it to come up with the gross billings per user by just dividing the gross billings by the number of users. So 20 billion divided by 40 gives me $500 in billings per user. And dividing the net revenue gives me a Uber share of the billings of 32.5%. So I get a net revenue and an operating expense per user of about $112. Now let me explain how I got the operating expense. Now, we know that at least on the face of it, Uber gets 20% of whatever fare you pay when you're an Uber user, right? But we also have these leak statistics, again, take them for what it's worth, that in a city like San Francisco, for instance, which is where Uber has had its longest and it has been around longest and has the business that's most established, the contribution margin, which is effectively what you're left with after you've met those variable expenses, the cost of servicing your users, is about 10.10%. So here's what I did. I took the 10.10% and I generalized it. Based on it, it looks like Uber has operating expense of about $112 per user. That's what it is spending to service its existing users. An estimate, but that's what I'm going to use. With that estimate, I get a projected overall cost, 112 million times 40 million, of $4.48 billion of its existing costs are going to service existing users. The remaining costs have to go into either getting new users or corporate expenses. I don't know what the corporate expenses are, but I'm going to, my guess, and it's a pure guess, it's about $1 billion, which leaves me with about $3.82 billion in expenses to get new users. In 2016, the number of users increased by 16 million. So if you divide the 3.82 billion that Uber spent in 2016, at least based on my estimates, to get new users, by the 16, I get $238.75 as the cost of adding a user. You're saying these are assumptions, piling on top of more assumptions. I agree. If you can get better information, replace my information, but you can already see why building user-based valuations will require more assumptions than doing an aggregated valuation. So I'm ready. First slice I valued were the existing users, and I made some assumptions. I assumed that these existing users, the revenues you get from them, that those revenues will grow about 12% a year for the next 15 years. What I'm factoring in here is once you're an Uber user, not only will you use their car service more and more every year, but perhaps they will sell you other products and services now that they have you on the roads. I'm going to assume that expenses, the operating expenses associated with servicing these revenues, that 80% of those expenses are variable. In other words, they will grow with revenues, but 20% are fixed, and those will grow at the inflation rate, which is 1.5%, at least based on my judgment. That gives me a growth rate in expense of about 9.9% a year. Now, I've allowed for a lifetime of 15 years for a typical user. Now, you might say that's low, that's high. I have no idea what's low or high. I'm going to use a 15-year life. I'm going to also assume that 95% of the existing users renew each year. So if you think about the compounded probability, about 46.3% of all users will be around all 15 years. The remaining will drop out in year 1, year 2, year 3, year 4, etc. In fact, my weighted average life of when users drop out is about 3.75 years. I've got everything I need. I project out the earnings and the cash flows given my growth rates. I net out the taxes, even though Uber probably will not have to pay taxes for the near term because of operating losses. I take the present value using a 10% cost of capital. Using why 10%? Nothing fancy. I use the 75th percentile of cost of capital for US companies to do the discounting. What I got as a value per existing user without adjusting for the dropout rate is about $714 per user. But given that I'm going to lose users along the way because of the 95% renewal rate, the adjusted value I get is about $410 per user. Based on my judgment, a typical existing user at Uber is worth about $410. You multiply that by 40, you come up with a total value of $16.4 billion. Now, one of the questions you can ask about the value of users, what drives the value? Obviously, user lifetime matters, and the growth rate that you get in revenues, annual revenues each year matters. The longer a user stays on, the more valuable that user is, but the higher the growth rate you can get in the revenues per user, the more valuable. In fact, I would argue that the value increase you're going to get in existing user value is greater by pushing up the growth in revenues, by selling users more stuff, than by trying to get them to stay on for longer. And you can see the value can go from $114 in my most pessimistic scenarios to $1,548 in my most optimistic scenario as the value per user. So let's move to the value of new users. To value the new users, here's what I'm going to start with. In 2016, these are based on my judgments, the value of a user was $410, and you saw that in the previous table. The cost of adding a new user based on that allocation of expenses I made in 2016 is about $239. Each new user for Uber in my base year is adding $171.5. I'm going to allow that value to grow over time at the inflation rate, and I'm going to estimate how many new users Uber is going to be able to get over the next 10 years. To get those new user numbers, I allowed for a growth rate in my number of users to be 25% a year for the next 5 years and 10% thereafter. It gives me total users of 164 million by the time I get to year 10, a quadrupling of my user base. Now you might say that's too pessimistic, too optimistic. I'll let you be the judge. But those new users times the value per user gives me the value added by new users each year for the next 10 years. You're saying what happens after year 10? I allow the number of users to continue growing, but I allow it to grow at the same rate as the economy, and I use the risk-free rate as my proxy for that. The present value of new users added beyond year 10 is the $7.03 billion that you see as the terminal value. I discount them all back at a 12% cost of capital. Again, nothing fancy. I use the 90th percentile, arguing that new users are more risky than existing users where I used a 10% cost of capital. The present value that I get for new users is $20.19 billion. Here again, I can ask what-if questions. What if I can grow the number of users at 10, 15, 20, 25%? The more I can grow my users, the more value added. I also looked at the value added by a new user. And you can see as I get more value added for each new user, the value of my new users increases. Now, the effects are obvious, but you're saying, why even look at this table? Because companies sometimes might have to make a trade-off. Trade-off in what sense? Let's suppose I gave you a choice. Would you rather go after a 10% growth rate and a $250 value added per user, or a 25% growth rate and a $50 value added? You can already see that the lower growth, higher value added combination gives you more value for new users. Companies have to decide what's right for them by looking at that trade-off between value added and going for more users. Which brings me to my third and final piece of this valuation, which is the corporate expenses. I assumed that in my base year, that expense was about $1 billion. And as I said, I have no solid reason for this. You could disagree and say it's nothing. It could be $2 billion. That number I'm going to assume is going to grow at about 4% a year, well below the growth rate of my users or revenues. I discount those corporate expenses back to today using my 10% cost of capital, my existing user cost of capital. You could even bring a third cost of capital into play if you really want to make this fancy or messy. The value that I get is minus 10.4 billion. You're saying, what does that tell me? That's the value drag I see from having a corporate expense that's going to continue over time. I'm ready. Here's what I get as my value for Uber. I take the existing user value, 16.4 billion. I add the new user value, 20.2 billion. I come up with a value from the users of 36.6 billion. I subtract out the corporate expense drag of 10.4 billion. I get a value for Uber's operating assets of 26.2 billion. I add the $5 billion cash balance. That's my estimate based on the 7.2 billion that they said they had a few months ago. And I add the slice of DD Chuxing that they got in return for leaving China, which I estimated to be worth 6 billion. I get a value for Uber of 37.2 billion. They have no debt, so that becomes the value of my equity. Now, incidentally, that value is not that different from the value that I got in my aggregated valuation. And you can accuse me of just reversing into the number. But as you can see, you can drive the valuation of Uber from the bottom up by starting with users and building up. So if your critique of discounted cash flow valuation is that I'm looking at the whole company, that's the problem you have with the way I've approached the valuation. If you want to value business based on users or subscribers or whatever disaggregated unit you want, you can do it. Just be aware of the fact that the assumptions you have to make on a disaggregated basis are often more onerous, more complex than the assumptions you have to make on an aggregated basis. I think, though, that it does make sense in a company if you have the information on a disaggregated basis to build up to a value. Incidentally, if you're wondering how VCs come up with this number, after all, they talk about how much they're willing to pay per user. I'll let you in on what I think is a dirty secret. VCs don't value companies, they price them. They don't value users, they price a user. What does that mean? Well, think about what Uber's most recent pricing was, 69 billion, right? It had 40 million users. You divide 69 billion by 40 million users, you get $1,725 per user. You're saying, what am I going to do with that? Well, you take Lyft's pricing and you divide by Lyft's users, you come up with the price per user for Lyft. Let's say it's 1,500. You could compare those two numbers and say, Lyft looks cheap to me. What I'm paying per user. So when you see people throwing around numbers for users, they're usually talking about pricing, and you can already see why that can be an extremely dangerous game. You can have lots of users, but the price you should be willing to pay for those users might be very low either because those users are not profitable or because they're not going to be around for long or because they're very risky. There are lots of reasons why the price per user could be low for a company. But the nature of pricing is you make some very broad assumptions about how businesses are run. But hopefully, at the end of this process, you have at least a framework you can use to value a company on a user basis. I hope you found this useful. Thank you very much for listening.